Welcome to today's webinar, courtesy of the Kentucky Small Business Development Center right here in Louisville. We're all about hooking you up with free, super secret business coaching and training services. It doesn't matter if you're just dipping your toes in or gearing up for a big expansion. We've got the goods, the tools, and the know-how to help you win. To get the scoop, cruise on over to LouisvilleSmallBusiness.com or hit us up at 502-977-5800. Big thanks for tuning in to today's webinar. Feel free to drop your questions or chat it up with our speaker using the chat feature. Let's dive in.
Hey, welcome everybody. I am Dave Etkin. I'm the director here at the Louisville Small Business Development Center. And as always, I'm joined by my good friend and co-worker, Janet Flaw. Hey, Janet.
Good afternoon. Good Tuesday afternoon.
Yeah. So, yeah, it's a great day today out there. And as you just heard on the video, we are, a statewide organization. We have centers all across the state, and we are here to help you. If you need anything, please hit us up. And as always, if you look at the bottom of your screen there, you'll see a toolbar. And if you don't, just scroll down there with your cursor and it should pop up. And just to make sure that everything's working well and you can hear and see us, just type in the chat. You'll see it there. It's this little chat button. And type in the chat and tell us hello. Tell us what your name is and where you're joining from. So it's always fun for me. This is the best part.
So I just put a note in there, so kind of you should see where that's popped up at the bottom of the screen with a little red 1 or something like that. So there you go.
Yeah. Carolina from Louisville. Sam from Louisville. Hey, Samantha. Good to see you. Clarice from Lexington. Nice to see you. Thanks for joining. Maria from Lexington. Got some Lexington folks today. Reginald from Louisville. Yeah, we get people from all over the country sometimes, so it's really exciting for me to see that. Hi, Amy. Thanks for joining us today. So, yeah, so, if you have any questions or comments as we go through today, just put them in the chat there and we'll stop and we will talk about it and stuff. So, hey, Mariah, thanks for joining. Today we'll be talking about the financial portion of your business plan, trying to put all that together. So what we'll do today is, let me just pop this thing up here. Oops. And hopefully we can kind of answer these questions for you. Because putting the financials together on a business plan is extremely hard. There's a lot of guesswork, but there are some tricks to doing that. That makes it a little bit less painful. But so let me just share my screen and we'll go through this and get going here. We'll dive right in. All right, how are we looking, Janet?
Looks great.
All right. So, so the 4 things we're going to look at today and putting your financials projections together is, first we got to understand what we need. So we'll talk about the financial statements that you need and then how to use them. And then the main thing, especially when you're on a startup or even as you're doing a growth plan, understanding how to calculate and understand your break even, it is super important. And this kind of drives everything else, when you put your business plan together, is understanding your break even and how to do that. And then once you have these tools in place, before you even complete your business plan, you can run some scenarios and see the different outcomes and from a projection standpoint. And that is key to a successful business plan as well, especially when you're talking to lenders or investors, because you'll often get a what if question, like, what if this happens? Well, you plan that out. Here's a scenario where that does happen, and here's what happens. So it's important to be able to do these things. I hope we can get all this done in about 45 minutes, but who knows? So again, I'm Dave Beck. I'm the Center Director here at the Louisville Small Business Development Center. We are a resource for you, no charge of anything we do. Everything's free. We can help you with your business plan, with putting the financials together. We have some great templates that we use, some Excel templates. We can take your information, plug it in, work with you on that. And the banks and most investors love these templates. They, we developed these in conjunction with the SBA, so it's pretty banker friendly. Looks good, it's professional. We can, so we've had a lot of luck with that, and please take advantage of that. So what are these financial statements that we need to put in a business plan? And we work with hundreds of people every year. And you just see all kinds of different forms, but you need to put things into a professional form that a banker who sees professionally prepared tax returns and financial statements in that form, so they can quickly understand what you're trying to tell them. And so the three that you really need to understand is the balance sheet, the income statement, and the statement of cash flows. And let's take a quick look at each one of these. And the balance sheet is a statement of the condition of the company at a specific point in time. So at the top of a balance sheet, it'll always have a date. It'll be December 31st, 2023. It'll be June 1st, 2024, a specific point. And it's only good for that one day. This is what we have. And basically it shows these three things. What does the company own, the assets? What does the company owe, the liabilities? And what's left over is the owner's equity. So if you think about it, the assets and liability side, they kind of balance out. So assets are things that make your money company. You make money for your company. So if you're going to go into business to open a lawn service, for a rough example, you'd have to buy equipment to do that. Those are the assets that you use to make money. The liabilities and owner's equity are the things that you used to acquire those assets. So you might have had to take on debt, or you had to come out of your pocket to in owner's equity to put money into the business to get that going from the beginning. So assets are things that put money in your pocket. Liabilities and owner's equity often are things that take money out of your pocket. So it is an equation. The assets equal liabilities plus equity. And assets are acquired being basically in two ways, like I mentioned, through debt, either through loans from banks or what we call vendor credit. And vendor credit is if I called up a supplier and said I need 1,000 units of something, and their terms are that they'll ship to me today and I will pay them in 30 days, that's vendor credit. So I, in essence, turned my vendor, my supplier, into a bank. They actually sort of gave me a 30-day loan. Or owner's equity. And we do that money that we invest as the owner. We put money in the business to get things going or prop things up later, or through retained earnings. So if the company makes a profit, instead of distributing the money out, you use that, you redeploy that money back into the business to buy other assets. So here's a balance sheet, and then you can see things kind of balance out. Where it says total assets, that number is identical to the bottom number where it says total liabilities and equity. And so assets in these financial statements are broken up into smaller chunks. So we have current assets, which are things that will be converted into cash in 12 months. And those are, cash is cash, so that counts. Accounts receivable, hopefully that's the money that our customers owe us. So for example, back, as I mentioned a minute ago, accounts receivable, where like a customer will call me and want me to ship 1,000 units to them, and I do, and my terms are that they don't have to pay me until 30 days. In essence, my customer has turned me into a bank, And I have to keep track of that. That's called accounts receivable. That's the amount of money my customers owe me on an ongoing basis. Inventory, we don't want to have inventory laying around, so that'll be converted into cash within 12 months. And then non-current assets, these are the longer term things. It could be buildings or equipment, things like that. Liabilities are the money that we owe, and same thing. Current liabilities are debt that we will pay within 1 year. So there's this other one, the offset of the accounts receivable is accounts payable, and that is the money that I owe my vendors and my suppliers that they gave me credit for. And then lastly, the owner's equity is the money we put in, and then the money that was generated by activities of the company. Well, darn it. Forgot about that. And the income statement is a little bit different. It's a statement covering a period of time. It could be a range. Could be from the year of 2023, or it could be the month of June, or the first 3 months of 2024. It's just a range of activity over a period of time. And the equation here is always set up the same. So at the very top of an income statement is always the company's sales or total revenue, less what we call cost of sales or cost of goods sold. And these are the things that we have to acquire or pay for before we can make a sale. So if I'm selling selling a pen, and pens, for example, I have to buy the pen before I can sell the pen. So that counts as a cost of goods sold. And so when I get money for selling this pen, I have, I don't get the full dollar amount. I get what's left over after the costs are deducted. Once you deduct the cost of goods sold from the total revenue, that's called gross profit. That's all the money that's left over that I can use to pay my company expenses, which would be, salaries or advertising, insurance, rent, all those other things. And then hopefully there's some money left over. That's net income. That's the profit. So the equation is just this: revenue minus the cost of goods sold equals gross profit minus all the expenses equals net profit. And there's only 3 things you can do with net profit. You can distribute it out to the owners. You can purchase new assets like we talked about, or you can pay down debt. And we'll talk about this in a minute, but when you make a loan payment, that amount is interest and principal, but we can only deduct the interest on our income statement. So it's kind of like a pie. If the owners take more money out, I have less cash left over to purchase new assets or to pay down debt, and vice versa with all the other. So here is a cost or income statement. At the top, we see sales, net sales, less all our cost of goods sold. Sometimes, and this example shows this, in addition to purchasing inventory or supplies, labor might be in there. And this often happens in manufacturing businesses, as sometimes you can put cost of sales or shipping or things like that in there as well. Less some other expenses, and then we have our net income, less our taxes, and then we have net income after tax. Darn it, I did it again. And then lastly, we have a cash flow statement. And the cash flow statement just follows the cash in and out of the business. And it just shows the beginning balance, less all the cash receipts that comes out of it, and then all the cash payments out, and then what's the ending balance. So here's one that just shows the different accounts coming in and out. And the reason we have these 3 things is because the different types of accounting. So we have a cash accounting, and that means that when transactions occur, the action is recorded when that happens. So if I was to go to a fast food restaurant and I buy some food, I pay the cashier right then and there. So that transaction is recorded at that time. And then whenever the company pays a bill, it's recorded at that time, when it pays. But accrual, and most times when you have inventory, you have to use accrual accounting. The transactions are recorded as they occur. And so if I sell something, I account for the sale at that time of the sale, but not necessarily when I get paid for it. So back to my example about the accounts payable. If I get a supplier to send me stuff and I don't have to pay for 30 days and I sell it, then I account for the transaction when the transaction occurred, not when I have to pay. So let's look at the two side by side. So here's a profit and loss statement, for example, and let's just say we have sales of $200, we have expenses of $70, and then we have a depreciation, which is kind of a non-cash charge-off. Here's our net profit, and then we have to pay taxes on our profit, which means we have a net profit of $78. But in that same period, the sales of $200 may be sales of things that people walked in and gave me cash right then and there, or it could be sales of things that I shipped and didn't get paid for yet. I sold it on credit, so it's a little bit of both. That could be the same with expenses. Let's just say I needed something in a hurry and I went and bought some inventory and I paid cash for it. So that will be in there, but at the same time, I may have ordered some things in and got them shipped in, and I have 30 days to pay. So both of these things are baked into there. So if we lay this with our cash flow statement, let's just say at the same period, we received cash of only $190. We paid out $80. And this is the exact same thing. The cash received may have been for sales at that minute, or it could be cash I received from sales that happened 6 months ago. It could have been an old debt. Same thing with the payments. I may have ordered something and I paid right away, or I'm paying something I've paid on something from 6-8 months ago or for 30 days ago. And then we have taxes. Again, we have to pay that. Taxes we are the same because we pay in cash. You can't pay your taxes on credit. And then that means this, after we deduct all that, we have cash left over from $68, and then we have to make our principal payments, and then we have net cash left over. So these two don't add up. That's why we have to have these offsetting financial statements. So how do we use all this stuff, and how do we put this together for our business plan? Well, what we need to do is do the best we can with our first pass, and we want to tell a good story. So we want to lay this out side by side. So in your first, in your business plan going forward, your projections, you don't want to have a single P&L like this. Your first year, you'll want to have by month, month by month, side by side. So we want a kind of a comparison. And these, the revenue may change. These things are important to project forward. Same thing with wages and salaries. Whatever it is, just kind of put that in. Also, you would want to add in this additional, flavor, the percentages, and it allows a banker or someone else to really understand the relationship of the different numbers. And when you just see a number either alone or side by side, it's kind of hard to understand the bigger picture relationship. When you put these percentages of total revenue side by side, then kind of it gives a depth of understanding. And the way I like to think of percentages is this way. If you look on our total revenue line, that's 100%. So I can use the analogy that the 100% is $1. And then the rest of the numbers kind of make sense. So in May, we see that, at the top, our total revenue was 100%, of course. less our cost of goods sold, which is 26%, and our gross profit was 74%. What that says to me is that for every dollar I sell, 100%, it costs me 26 cents or 26%. I get to keep 74 cents to pay all my expenses. In June, because of some changes that you can see, our total sales was 120, significantly more. For every dollar that I sold, it cost me 50 cents. I only got to keep 50 cents. So that's an easy way to understand the relationships. That tells me some things about those numbers, that even though the numbers look like they're increasing and doing well, the relationship is not so great. And it's the same way to analyze your expenses. You can use these different percentages to do that as well. Well, darn it. And, okay. So here's some helpful tools that let's look at, especially this break even. And so when we talk about break even, I'm going to go through some things that are sort of maybe a little bit too much, but when we get through this, I'll show you a spreadsheet that I'll send you later on that you can use to put all this together. It's really easy. It's a lot of fun. And you can even use it to make decisions ongoing after, your business plan. So understanding what break even is this. An accounting break even is the point where the expenses equal, the revenue coming in. And when you are putting your business model together, it's important to understand this, because you can use your cost model to guess how much revenue you need to get in to cover everything. And then you use that to make your case and your projections. So there's 3 simple steps. You get your expenses together and you classify them on how they behave. We'll talk about that in a second. Then you calculate your break-even point. And then lastly, you use scenarios to make decisions or rework your business model. It's just that easy. So here's some key terms that you need to remember when you do this. You need to understand variable costs, fixed costs, cost of goods sold, the gross profit, and then what we call the contribution margin. So let's dig in a little bit here. Variable costs are things that change in relation to sales. So back to the pen example, I have to buy these in order to sell them. So if I'm selling a lot of them, I'm buying more of these. So it will change. It'll go up or down based on sales. If I'm not selling anything, I'm not going to order, or shouldn't order, a bunch of pens in to have them sitting around on the shelf. So this is called a variable cost because it varies with my sales. And so it could be a bunch of things in addition to this, which is the cost of goods sold. Like a list here, like commissions or packaging. Packaging is a great example, because if I know that whenever I sell one of these pens, I had to put it in a specific box and it cost me this, I can calculate that. Sometimes if you are a franchise business or you have an affiliate marketing agreement, you might have to pay royalties. So that for every item you sell, a certain percentage of the sale price would go to your contract holder. Merchant fees, transactions with credit cards, sometimes labor. Then fixed costs are those are costs that just stay the same regardless whether you make a sale or not. So rent is the rent, whether you're busy or not, you got to pay the rent. Insurance, if you have a salary, that's an obligation you have to pay. And then your debt, the bank doesn't really care whether you have sales or not. They want to get their pay. That's get their money on their monthly payments. So here's some formulas that you have to know to calculate these things, because the language of break even is not dollar values for the most part. It is percentages, because it's a relationship. So we need to understand what the variable cost is, and we calculate that by taking whatever the cost is and divide it by total sales. So if I'm going to sell this pen for $5, and if this pen costs me $1, then I take $1 and divide it by $5, and that gives me 20%. That's my variable cost. To calculate the contribution margin, that's almost like gross profit in a way, but you can add in different factors like sales commissions and things that we talked about. You take 100%, which is the total sales, like we talked about on our P&L, and then we subtract out the variable cost percentage, not the dollar amount. And then it is this simple. You take the fixed costs and you divide them by the contribution margin percentage, and that gives you your break-even point. So here's the example. Business has sales of $500,000 with fixed costs of $250 and variable costs of $100,000. So you just take the variable cost percentage. We got to calculate that. So we divided 100,000 by 500,000. That's 20%. The contribution margin is 100% minus the 20% equals 80%. So the break-even point is $250,000. Our fixed cost divided by 80%, that means $312,000. Easy peasy, right? You can do it on your phone. So when I went to business school in college and all, this is this thing we had to calculate, was a break-even point, and I never got the why we did this, because there's nothing you can do with this. Come up with this graph, it was a pain in the butt to do, but that's what we had to do. And it makes no sense to me, but there it is. I'm showing it to you. But what we want to do is understand these things, how to put it into a business plan. So when I run my business plan and I'm trying to calculate my cost of goods sold, now there's some businesses like this, not a lot, but if all I sell is this pen, it's easy to calculate that. But more likely, I sell this pen, and maybe I sell this pen, and I sell this marker, and each one has a different price and a different cost of goods sold. Well, how do I bake all that into coming up with my big cost of goods sold? Well, that's kind of the trick here. So the important thing is to understand what these things are, and this is a simple thing. And here's an example for you. In the restaurant setting, because if you're going to sell a ham sandwich, for example, or a club sandwich, I guess this is, you have different ingredients with different costs. And if you're just reselling a product, that's one thing. But if you have to put something together with different costs, you have to calculate what your costs are, your cost of goods sold. So what we would do in this example, we measure out all our ingredients. We have a menu. We know what each ingredient costs that we get in bulk. We divide that out by the ounces that we're going to put on the sandwich. So we know that our ham, it costs us $3.99 a pound. So we can divide that by 16 ounces, which is in a pound. We know that our 4 ounces of ham was going to cost us $1. Same with the turkey. We add that up, that's $3.56 is the total cost. If you look to the right there, the sales price is $79. We divide that by or subtract out our cost of goods sold. Our gross profit is $443. So we take our costs, we divide it by our price. That gives us our variable cost percentage. So it's 356 divided by 79 equals 45 or 0.45 or 45%. So that's how we calculate that when we're doing construction like that. But back to the example. So I have these 3 items with different costs of goods sold with each one. So the sandwiches we just calculated is 45%. Let's just say we have the sides that go with that, it's 30%, and beverages are 10%. So that's the difference. So what we need to do is what's called a weighted average variable cost percentage. And again, when you're doing a startup, you have to guess a little bit based on what you know, make some rational assumptions and make your best guess. But What I could do is take the cost of goods sold percentage, add them all up together, but that's not realistic, is it? Because my sales mix might be different. So what we want to do is understand and calculate based on what we know, what will be the difference between the sales volume for each item. So what we would do in this example, you can see where it says percent of sale, it means that when in this example, 80% of our sales are sandwiches, only 10% are sides and beverages each. So all that adds up to 100% of sales. So when we multiply that out, then the 45%, times 80% is 36%. Then we add those up, and then the blended average is 40% based on the volume of sales for each individual items. I know it sounds kind of complicated, but once you do this a few times, it's not so bad. So, so based on everything we just talked about, we calculate this out. So we have 100% sales. Our cost of goods sold percentage blended is 45%, and then our gross profit is 55%. And then from there, all we do is add in the different things, and then we can calculate that out. So once you understand these percentages, you can do several things with them that makes it quick and easy. That you can do things on your phone. So I don't think we should go into all that at the moment. But so what we should do now, though, is look at how to do this and make decisions based on what you know, what you calculate, and what you capture to put your business plan in place. Because what we're after here is a rational financial projection, based on fact, and that you can understand and be able to quickly articulate to an investor or a banker. And it's easy just to take this like a profit and loss and just plug in numbers and just think, oh, I think I can make $1 million selling lemonade, maybe, but more likely not. So let's just stop here for a moment and go and look at the spreadsheet here. How are we doing, Janet? Does it look okay?
You're good.
Okay, thanks. So back to what we were talking about. If you remember, we just calculated a bunch of our variable costs, and this is a restaurant example. So let's just say that, for example, we calculated our blended food costs based on those 3 items that we had, that we talked about. We would just add our percentages over here on the variable cost column, and then project and understand what our fixed costs are and put those in a monthly column over here. So let's just put some numbers in here. So our food costs we calculated was 40% based on what we knew of the blended numbers. In most restaurants, you want to budget based on industry averages and kind of work through your operations plan. You want to keep it around about 20%. Back to the restaurant example, for those of you folks in the restaurant business, there's a thing called prime costs, and that's food costs and labor percentages added together should not exceed 60%. Otherwise, you'll be over budget. Makes it a little bit harder to survive with that high cost. And then you can add other things in here. If this is a franchise business, then we want to add in a royalty. Let's just say you want to, you have some discounts, coupons and things on average, 2%. We'll put that in there. So this all adds up, and so you can see that Our total variable costs are 70%, which is pretty high. And then our monthly fixed costs, we just add in here. What are the things that we would have to pay every month? So in this example, we have to pay our accounting company $150. We have insurance. We have a legal fee. We have LG&E. We have a manager's salary. That's pretty fixed. We have that. We have rent. We have our phone. We have a loan payment of $500. We have the pay for trash. Let's take this out of here for a second. And then anything else we open here. So that means that each month our fixed costs are 11,000 and our variable costs are 70%. So then we calculate our gross margin here. So again, remember we have total sales, which are 100%, less our variable costs, which is 70% from there. That means there's 30% contribution margin. So that means for every dollar that we sell, 70 cents goes to cover the variable costs, and we have 30 cents left over to pay our monthly stuff, monthly fees, or monthly expenses. So we need to know how many 30 cents is, or 30% we need to cover our monthly, just to cover everything. So you put all this in, then we have down here at the bottom, let me make it a little bit bigger. We can see that our fixed costs, multiplied by 12 is 141 divided by our contribution margin. That means that our annual break-even sales are $470,000. That's a big number. I like to use smaller numbers so I can understand them. I can divide that by 12. That says 39,000 a month, or 91,000 or 9,000 a week, or $1,300 a day. And once you get an operation, these numbers, knowing your break even is great because, for example, in this restaurant, let's say it's a Tuesday night, and I'm working, and I close out and Z out my register, and I look at the sales for the day, and I see that it was $1,100. And then in that moment, since I know my sales for that day were $1,100 and I know my break even, I know that I didn't make money today. I didn't have to wait for the financials from the accountant. I didn't have to do anything. I knew on this day I didn't cover my costs, so I need to double down the next day and kind of make up for that. So this is a great way to understand things going forward. And then also, when you are putting together projections for your business plan, this is important as well, because if you have a business and you put your business model together and you plug all this in, and you look at that $470,000, and based on what you know and your research, you think on a great year I'll never hit that. Well, then there's something wrong with your business model. You need to change something to make it better so that you can make money. We can also use this to make decisions. This is the fun part that I really like. I've added this tab here. I call it scenario planning, where you can line things up side by side and make decisions. So here's some numbers that are just kind of plugged in here. So in scenario 1, we have 30% food costs. We have 4% paper. We have 20% hourly. I can budget in a profit. I just say I want to make 4% profit. That means for every dollar I sell, I'm going to make a profit of 4%, and I have to put this model together. And I can do the same thing with a different scenario. What if I change my menu so my food costs go down, and I want to make more profit? I can plug that in there. And then the same with monthly fixed costs. Next example, I decided to do laundry in house. Manage, maybe I'm going to move, and where I am now is $3,500. In a new example, it's going to be $10,000 here. I can also budget for $1 profit each month. So in this example, I want to make $2,000 a month or $5,000 a month. So what does that look like from a break-even standpoint? We do our same margins, $1 less our variable cost less our contribution margin. And then we look at them side by side. So in scenario one, my fixed cost is 145 divided by 42% equals 345 in sales, or 28,000 a month, or 6,700 a month, or $900 a day. And in scenario two, I need to make $738,000, or 61,000 a month, or 14,000 a month, 2,000 a day. The big difference in each is that I budgeted in a bunch of different profit in two ways, and so that's my break even. So I hope that makes sense to everybody. So once you do this, then that is when you start plugging in your financials and understanding. You have a great understanding of what needs to go in there. So let's see what we got here. So Carolina, how are you? So Carolina says, is there a way that we can have a class to learn how to create these Excel sheets? So which, are you talking about the break-even sheet, Carolina, or the P&L and stuff? So I will send this to everybody. This break-even calculator. This is one of my favorite things to play with, is this. So I can send everyone this, and you just plug in some numbers. It's got the formulas in it, and it will do all the stuff. You can use it. I use it to make decisions almost every day. Doing a profit and loss and a balance sheet and a cash flow statement is a bit more tricky, and this is something that yeah, okay, Caroline, thank you for clarification. So there's a ton of these templates and stuff, so I'll send you a simple one that you can use as well. We have some templates that we use. They're kind of proprietary. You can send, where we can, I've sent them to people, and it's got all this stuff baked into it, and generally it's really easy to mess it all up and get wrong numbers out of it. So generally, I would, if you want us to help you, you can get get a meeting with one of us, and we can help you put that all together. Again, we don't cost anything. You mentioned you might want to pay somebody to do it, but why pay somebody when you can get it done for free? So I'm going to put our link in the chat here. Let's see, what is that? So this is our Coach Connect page, where you can set up an appointment with one of our coaches, and then we'd be happy to do that. But I'll also send everybody a simple spreadsheet where it'll calculate your P&L and your cash flow and stuff. So that's the hard thing, is taking all these things that populate the balance sheet. That's a tough thing. So that's why templates are really important to use there. So this is my favorite question, Clarice. How does a business that hasn't sold anything yet determine sales per month? Great question. So we use what we call critical assumptions. And those are things that, based on what you know about the business or the industry or your personal experience or your research, you can assume certain things and use those to make an educated guess on the future. You're predicting the future, and most times you'll be wrong, but hopefully you'll be directionally correct. So here's the example I like to give. When I was in school, here's a question I had on a test. And if you have your chat ready, maybe you can just give me the answer. But so here's the question. On a business test, how many golf balls in the United States? That was the question. And this is exactly the same process that you would use to determine sales per month when you haven't sold anything. So how would I do that? Well, I would have to think about, what do I know and what can I use that information to make calculations with? So what do I know about golf? I know zero. I don't play golf, don't know anything about it. I know there was some sort of golf thing going on last week, heard about it, don't know anything about it. So, based on what I hear, I'm sure there's a fair number of golfers in the United States. So there's 350 million people in the United States, maybe 10% play golf. So I could get that number. So how many golf balls does one golfer need? Again, I don't know, never played, don't know anything about it, but I've seen them on TV where they drag that golf cart thing around and they have clubs in it, and it looks like there's a little pocket in there. Maybe 10 balls could fit on that. I could do some research and get an average, then I just do the math. Based on what I know, I can multiply, and that would give me a rough estimate based on what I know, my critical assumptions on how many golf balls in the United States. So you would do the same thing with your business. So for example, back to the restaurant business, since people kind of understand that, I can do some research, and if I was going to open a pizza shop, I can do things like go to pizza shops and kind of watch how many people come in. I could do some industry research with trade groups and get an average store sales. I could actually be stealthy and call a store and say, hey, how busy are you guys? And then if I can get an average of, there's a thing in restaurant business called check average. I can just do that math. I can check average is like the number of customers come through a day and their average sales. What is that? So you could say, if my check average is $10 and I know that people are going to come in on average of 100 people a day, well, I can do that math. So it's kind of a trick. We'd be happy to talk through that with you. So Samantha says, how do you calculate your labor costs if you have different employee positions that make different hourly pay? What costs go into calculating the costs for hiring employees, or is that too detailed a question for this webinar? No, it's not too detailed, but when you do your business plan, again, it's all about sort of predicting the future. You have different employees. So if you're going to set up a business and you're trying to calculate that, and you haven't hired anybody yet, you have to understand what it's going to take to take care of the customer. That maybe based on your business model, you need 4 employees, and the other maybe, they might pay, one person gets paid $20 an hour, and the other gets 10. But it's all about doing the math and figuring things out and putting it down. So you can add that all up. You can multiply that by the number of hours you're going to work. That's fairly straightforward. Or if you're going to pay somebody a salary, that would be easy to plug in. If sometimes that you might have contract workers, for example, maybe they do piecework. That's an easy one where they assemble something, and for every assembly that they complete, they get paid a certain dollar amount. Well, that's an easy math equation to do. But it's just a matter of kind of thinking through. I like to have like a thought experiment where I picture in my mind me being a customer and imagining making, buying something, and then what has to happen once the sale is initiated. How many people does it take to put all this stuff together or ship it or whatever? Is it possible to get access to competitors' numbers to give an idea? Yes and no, and that's another great question, Clarice. You're killing it today. Again, you can get averages from industry averages, like different trade magazines, or if you just Google rule of thumb numbers for the restaurant business. I mean, that's a big one that pops up. We have access to some databases that we'd be happy to share with you that has some of those numbers that they'll take like financial statements from a couple 100,000 businesses that are similar, and then kind of aggregate it and make an average. So it's all in percentages and not dollars. So it would be, again, like we just talked about, like the 100% of sales minus the cost of goods sold would be some percentage. So you can see what that average cost of goods sold percentage is. You could use that with our scenario planning, plug all that in. And again, there's direct research. I mean, I have sat in a restaurant for a day and sipped on a beverage all day and kind of counted people coming through the door and listen to what they buy. That's one way to do it. I mean, there's just a bunch of different ways to kind of calculate that. But the best way is trade magazines, just Googling, and then make friends with an employee or two with a competitor and see if you can get some information out of that. Sounds dirty, but that's the way it's played. So yeah. So yeah, go to Coach Connect and get on our calendar. Any one of us can help you. The links there, I'll put that up there. Samantha says, do you support in your office for finding which NEX code, NES, CES code your business would be classified as? So NEX codes, and then will that affect tax rates? No, it will not. Classifications don't affect taxes unless you are like a nonprofit or something, I guess. But the corporate tax is the corporate tax. If you're a pass-through organization like an LLC or an S corp, then it's tax based on your personal tax liability percentage or margin or bracket, I guess is the right way. So NEX codes don't make any difference. NEX codes are just used to classify businesses for that broader analysis, like I was telling you about, to get some benchmarking data. Yeah. Yeah, you guys really got some great questions. I really appreciate that. Again, this is one of the hardest things to do, is just basically, guess the future, what it is. I mean, it's easy to come up with your costs. You just call the insurance company and ask for a quote. That's the easy part. The expenses are the easy part. But predicting the future is the hard part, and it takes a little bit of research and running scenarios. That is really, really key. So, any other questions out there? Okay, I really appreciate you guys coming today. It's been a kind of a lot, and just a 1 hour webinar is, I'm sure you have tons of other questions, especially when you start doing it. So please reach out to us. This is what we do every day. So it's fairly easy for us. We have a lot of resources. I'd be happy to help you out. And again, I will share the break-even calculator with you and another template that will calculate your profit and loss, your balance sheet, and your cash flow statement, on your startup, or if you want to do a growth plan. And that's all based on your startup costs, the assets you have to buy in your budget. But if you're going to go to a bank or some other type of lender that needs a business plan, a good business plan, then I would encourage you to reach out to us, because we have the templates and the tools and that we can help you do that. We are going to send a replay as well. This will be on our YouTube channel later too, so you can watch it as many times as you want. If you go to our YouTube channel, there's a ton of other stuff on there that you can check out. If you're so inclined to watch us week after week, I appreciate that. So again, thank you so much. It was great to see everybody, and we will be here next Tuesday again. And I hope you have a great Tuesday. And go to Coach Connect. There's the website, LouisvilleSmallBusiness.com. Up the top, there's a little button that says Coach Connect. Just head there. You can see all of us. Just schedule a Zoom call with one of us right then and there. So hope to see you soon. And I'll see you next week. Have a good Tuesday. Bye-bye, everybody.